In some way, we are creating models for future regulation, which most likely will be required by regulators as a best practice and recommended for banks to do that. So you are developing something which will be used everywhere, as I mentioned, maybe in 10 years' time.
Välkomna till Kredit i Klartext. Mitt namn är Valdemar Gromov och jag driver den här podden för att tillsammans med våra gäster bättre förstå hur olika regleringar och tekniken påverkar kreditmarknaden och i slutändan konsumenter. Idag har jag Alexander Petrov som har spenderat mer än 10 år på Nordea i olika ledande positioner. Och vi kommer att hålla den här episoden på engelska. Welcome Alexander to this episode. Happy to have you here.
Hello. Hello. Nice to meet you again, Valdemar.
When we kind of crossed paths for 10 years ago, you've been working on the rating models, right?
IRB models.
IRB models that
yes.
were quite established at that time as well, in terms of regulation, in terms of methodology, in terms of how you proceed and do that. I mean, regulators had their kind of guidelines and so forth. So can you tell a bit like the development, how and when did you start kind of looking at those questions? Like, for instance, you mentioned right now that regarding like climate risk, for instance, that are outside of the given regulation, outside of what is there, because many of the banks, they kind of simply follow the guidelines and then develop what is stated there. When did you start kind of pushing that frontier?
Yeah, good question, actually. If you are talking about my involvement in this research, which may be a little bit outside of what actually my job requires me to do, so that was quite a long time ago. It's already in 2008. I have started to look in the IRB modeling foundation, meaning that connection of probability of default to capital requirements. And during that time, actually, I did some research and published paper about separation from probability of default through the cycle component and point-in-time component, based on idiosyncratic risk factors for each obliger and common economy cycle impact, I would say. So that's foundation which actually was introduced, I think, published 2012. And in Journal of Risk Model Validation was extensively used after by many banks for IFRS 9, stress testing, and IRB, but climate risk didn't come into play yet. So when banks started to see how to include climate risk, for example, in stress testing, they come to exactly the same problem. Because typically in stress testing, you have bottom-up and top-down approach, meaning that from one perspective, you have that, for example, transitional risk in climate risk scenario will impact GDP, and it's typical parameter for stress testing model. So you have a decrease in GDP and all companies impacted by the same GDP decrease. But from other perspective, you also have client-based or obliger-based impact. It was quite fundamental that you can separate this component and model it totally separately. In this case, you can take into account both impacts in one model. So that's just example.
So as I understand, you were simply trying to solve one of the issues that you had back then, and you discovered that not all, but some problems related to the credit risk modeling have been actually tied to the such events as GDP decrease, and has been which in turn has been tied to some scenarios, maybe catastrophic scenarios.
Yeah. The key here is you need to apply both portfolio level impact like GDP and micro impact on obliger level or company level like carbon tax. So that's why this method actually working very well. So you can do both in one framework, in one methodology. Both together. So in typical scenario, stress scenario in this case can give you both. Okay, you have certain GDP fall due to climate crisis and also carbon tax rise. So you have all these digits in stress scenario. So you can just apply them to your portfolio. It will be both bottom up and top down effect.
Okay. did that, and then after a while you got the chance to kind of take this work to a whole new level involving academics and kind of positioning it for the, as you call it right now, the climate risk matter that is much bigger and maybe much more, well, attracts more attention, I would say. Did you get any, I don't know, you are basically leading quite large team at the bank at the moment. What role did it have?
Maybe I need to correct here. I'm not a direct manager right now, but I'm executive advisor and I'm functional lead. That's correct. So yeah.
Okay, thank you. Maybe you can tell what role did this involvement of academia have on your colleagues, on your team?
I would say that actually we in the very beginning, it's a very good project. And from bank perspective, we allocated, it's not only me actually, it's several more persons. We allocated on best effort basis, meaning that it's outside our working time. So it's not much time actually I can spend on that. But what is big value in all of that setup is we have three main components for very good project in this area, meaning that we have quite good researchers team in Stockholm and Lund University, which allocated 100% on that. So they are working full time. We have also cooperation with global credit data, which will supply all data needed for that. So all quantification, all evaluation, everything. So we have data, credit data from around the world. So it's not only Europe, it's not only Sweden. And we have industry involvement, meaning me and my colleagues who will guide all that work and researchers in the right direction. So the output of that will be needed for industry and will be used by industry. Maybe I can describe also a little bit objectives of this project. So first of all, having this very good data set in place, global credit data, we'll look at different geographies and regions which already impacted by climate risk, physical risk in this case, and we'll see if we have impact on credit risk parameters like probability of default and loss given default. Then as a next step, we will see if current models reflect all of that in correct way. So classical models, which is used everywhere in all banks. Based on that, we will suggest the improvement of models and how they can be changed and what we can update, etc. So it can be many improvements. So what will be best models for this situation where we have climate risk impact? And at the end also of the project, which is also my area of involvement, we'll look at how can I calculate capital requirements for climate risk.
Okay. So you mentioned this different geographies, for instance. Many people see that climate risk is some kind of a distant problem somewhere else. Does it already show up in any way in the Nordic credit portfolios?
I would not say that from losses perspective, we have a kind of huge impact. But the question is what we will have in 5 years and 10 years. So that's why that's a tricky problem to solve. So even we maybe don't have huge now impact, but already some areas in, for example, Holland, we have areas which is overflooded. So and they have real impact on real estate, on loss given default for different properties. And as far as I know, also in, for example, South Asia region. So they already impacted quite much. So they quite seriously look at that, estimating losses, running different scenarios and allocating capital on that. So it will be more areas sooner or later which will be impacted by physical risk. But also we have transitional risk, which is on the way all the time. So the question is when it realized in full 100%, I would say. So it can be a very big impact in this situation.
Mm-hmm. And those physical risks, as you are mentioning, is that anything that the banks or lenders or those property owners can simply cover by insurance, or is there any such insurance market in place at the moment, or are we talking about like longer time horizon that basically would mean that there would not be any insurance market?
Yeah. I cannot comment much about insurance, and in this case, even reinsurance, I would say. So it's not only insurance. So that's even I was work as an actuary before in this. I just from modeling perspective, because I'm working with models, I can say that now we have a trend. I would say to not to combine models, but to have common efforts in modeling of this impact, because both banks and insurance actually modeling the same stuff, loss given whatever scenario we have, so or loss given physical impact of change of climate. So I would say that in this sense, both insurance business and banking business starting to cooperate.
I would say, historical way that where the banks could simply cover themselves with some insurance, that is kind of not the case anymore. Is that your take?
No. That's insurance involved also. Of course, in this damage, we have different impacts on different players, I would say. So it's not like only banks taking all impact. That's, of course, not correct.
Okay. So maybe you can...
But from models perspective, we need to look in each other models. That's outcome of that. So banks need to look also in insurance modeling, how they model, because our loss is depending on that also. So
yeah, that's for sure. So I guess that you are taking the bank's perspective in the first place when you are...
Yes, correct. So yeah, that's correct.
All right. So from the bank's perspective, or could you walk us through maybe how this kind of events are already incorporated in the existing models, for example, IRB frameworks?
That's also a very good question. And I would say all banks need and do that, because we need to do it according to recent regulation from, for example, coming from European Banking Authority and translating on all local regulators like ECB, like Swedish Financial Inspection, for example. Yeah, but the question is how you can do it, especially how can quantify all of that. So, and here we don't have kind of common best practices. So this best practice arising just right now. So it's not like they can copy paste from some books, for example. How can I do that? Taking, for example, IRB models, yes? So we have risk parameters, probability of default and loss given default. And of course, we can trying to include all this climate stuff here. And the question is, do we do it correctly? For example, probability of default. Many banks now doing just kind of overrides, which based on expert judgment or kind of qualitative framework. So you can just diminish some ratings, for example, or increase in probability of default due to you think this customer is impacted more by transitional risk coming from climate, etc. So, but it's not pure mathematical or quantitative modeling, I would say, in many areas. For example, also it can be in IFRS 9, it's applied overlays. The question here, because IFRS 9 modeling future expected losses, and of course you should take into account climate impact in future expected losses, because we have that. But the question is how you do it, and there are also no best practice how in good way to quantify that. So in many cases it's just kind of add-on or overlays, so which quite expert based, which can be not correct. So that's why kind of cooperation when university, industry, and data providers can create robust models for all of that purposes in credit risk modeling, it will be very good value for all banks, I would say.
That's great to hear. So how different are those approaches that you are working on compared to, well, traditional credit risk models? Is it about completely new mindset or new data, new parameters?
We are starting to include and all banks starting to include in their risk databases climate risk related parameters. That's completely true. So we didn't have them before. For example, 10 years before, we didn't have such data, such parameters in our database for credit risk modeling. So certainly we have both new data included already in modeling and also new type of models, first of all, in stress testing arising such models. So which I was working intensively recent time and also made kind of research mentioned by my paper from 2012, which is used also in stress testing. So here area where we come in front of everything, I would say. And the next area I'm involved currently, which I'm doing research outside my working hours, It is related to capital requirements for climate risk impact. The problem here in IRB approach, for example, is following that capital requirements which is banks using today, and it is minimum capital requirements bank should have, is based on approach where we have, with assumptions, we have cyclicality, meaning that we have cyclical probability of default, which actually rises in downturn and improves in upturn. But if you have climate risk on this picture, it's not will be like that. We have constant deterioration of through the cycle PD due to climate risk, and also asset correlations, which is used in this approach, is not the same. So most likely they will be much more higher in the presence of transitional risk. So all companies simultaneously will go to default and they have a problem with financing. So of course asset correlation will be very, very high in this case. So this formula and this approach, which is actually Basel IRB approach, should be adjusted or improved in this sense. That's area actually I'm working with now, and there are some attempts to do that. For example, some papers from Basel Committee were just trying to adjust that in mathematical way, so people starting to think. So it's just very recent papers, like from this year. It's not like even 1 year before I'd never seen this. And the first step in global credit data, for example, which we have cooperation with, we established process and estimation procedure for asset correlations in very different segmentation. So we can run this process for whatever segmentation we want, for country, industry, segment how we want, and calculate this asset correlation. This is the first step to this future development. So we can, having this in place today, we can estimate it when we see that we will have impact from climate risk for certain areas, for example, or for certain industries.
So now we are talking about those real kind of doomsday scenarios that usually, well, as I remember, so most of the credit companies would just say, well, if that day would come, then the society has bigger problems to take care of, but it's and then therefore we don't need to kind of model it that extensively. But maybe this is just like a very gross simplification in terms of how you kind of expect different outcomes. And as you say, that those asset classes on the global level, even on the global level, are kind of very much correlated in those very heavy downturn scenarios.
I would say that's exactly the area also I mentioned in the very beginning. We will have huge concentration risk impact because concentration will be not in the meaning of our classical sense of concentration. For example, concentration to one specific industry, So here can be many industries together impacted at once because of, for example, carbon tax. So in this case, it will be huge concentration impact. So that kind of stuff, of course, should be modeled and predicted a little bit before.
So you mentioned before that you are trying to make something that would be like some methodology that could be used by other banks on the market. How clear are the expectations from regulators like EBA, ECB, and the Nordic supervisors today in that area?
At the moment, we have situation that EBA wrote a guideline with general principle of estimation, and they cascaded down that to local regulators, which actually follow that and have similar requirements to the banks, I would say, as coming from EBA level. So they're quite general. They suggest you should develop quantification for this risk. You should develop methodology to estimate that, but they don't have any, direct clue how you can do it. So now the situation is the following, that every bank having this guideline, on the table, they just start to think how I can do that. And, it can be a very big spread of different practices. Maybe some of them can be not very good one. So that's why this work, it's very important now we actually creating future regulation, future best practices. So typically Basel regulation was created in end of 90s and the beginning of 2000 years, the similar ways. So they started to apply something created by researchers from before. So, and it became regulation. after some adjustments, of course, some parameterization, but our RWA formula, it's coming from researchers, which actually all banks using today as minimum capital requirements. We need something similar, or at least more detailed, I would say, guideline, more detailed guidance. How can I model this impact? Because all banks actually sitting now self and see, okay, how can I do it? And not every bank has many resources, to do it properly and in a good way.
Yeah. So if you can't avoid it, you need to kind of lead the way. And that's I guess that's
we are in front, and in some way we are creating the models for future regulation, which most likely will be required by regulators as a best practice and recommended for banks to do that. It's similar to Basel also, so they have some papers like they say it's called working papers or recommendations, where they say, okay, you need to apply for validation, for example, that approach. So it's best practice, and all banks now they applying that actually. So it will be the same here. So when it will be established good practice in modeling of climate risk for different purposes, for IFRS 9, stress testing, concentration risk, IRB. So it will be best practices and everyone will use it.
Sure. Did you get any, I would say, did you get any attention from talent from universities that maybe people have not been considering banking industry from the start, but got their eyes on the questions that you are working with after such projects?
First comment here from my side that university is very much appreciating that people from banking industry guiding them in right direction, actually, what outcome they should create. Because, when they are working on standalone basis, it's difficult for them to understand our problems and how we are working. We also have regulation. We cannot do whatever we want, like in university. So, and our actual involvement helps them to understand actually what kind of modeling we need at the end of the day, banks need. So we guide them in right direction how to create these best prototypes, or pilots, whatever you can call them, which later will be used in the banks.
Yeah, and maybe some public relations value for your bank as well to attract some talent.
Certainly. So these people, of course, very valuable resources for us. If they want to leave academia and start in industry, of course, they are welcome with such a background, especially. But I would say all banks want to have them if they will be in front of that. So of course everyone want to have them in place, so they are working now in front of very first line of this development. So
yeah. Well, that's the point when you're partnering with open academia, it kind of becomes public quite fast.
Yeah, and also it will be public through global credit data, because all these our papers will go through global credit data also, and it will be presented on these global credit data conferences as an example of cooperation of Nordens, Stockholm University, and global credit data, and it will be acquired by other banks around the world also. So it's not only a question of Scandinavia, for example, it's much more global credit data operating in the whole world. So we have actually impact by this research to whole world, not only Scandinavian banks.
Do you see kind of engagement from the areas that are more impacted by such questions, for instance, because you mentioned that maybe Scandinavia is not directly impacted in terms of those climate change risks to the same degree as you mentioned Holland, South Asia, but there are other.
Yeah, actually, I know this from communications and the conferences. Yeah, they are very much concerned. And I would say they are also these particular banks which are impacted much, especially big ones in these areas you mentioned. They already have quite advanced models in this area. So they are not waiting for university or for anyone or regulators who come in. So they need to have it because it's a question also of survival,
Yeah.
So they're driving it, and they have many resources for that. So in these particular areas, they're investing much money in this development. It's not like, of course, if you're not impacted much, maybe you will just follow regulations, so you will not be in the very front. That's understandable position. But in these certain areas, that's certainly they do that.
All right. And if we take the step further, like how could climate risk assessment indirectly affect consumers and small businesses? For example, will borrowers in certain regions or industries face higher credit costs, for instance? How would that kind of boil down to them?
I would say it can be, if this risk realized, it can be a quite huge impact on whole economy. Unfortunately, now, from very general picture, we are on scenario which we postpone quite much all measures which we should take today. And this, how it's called, physical impact of climate risk will be deteriorating more than if we would start transition today, which means that it can be sharp transition when this physical realization of physical risk will be quite enormous, I would say. And in this case, it of course will be very big impact in whole economy in comparison with scenario where you slowly introduce this, transition every day, so you diminish CO2, etc. So you're doing that. So many countries, you see maybe a report yesterday, so I have seen on TV, so continue, so we have increase actually of CO2 in the atmosphere right now from many countries. So we are not decreasing that, which means that at some point it will be so huge physical impact. So all governments has no choice, to implement these measures at one time. But it will be very, sharp transition in this case. And at this point, of course, it will be impact on everything. So it's even difficult to say. Even some companies maybe outside of this area will be impacted, like second order. It's not like direct impact, but indirect impact. If whole GDP will fall, of course, everyone will feel that.
My question initially was kind of to maybe take a parallel to the financial crisis during 2008. I mean, everything worked until the banking sector started to kind of realize that there is kind of no backing behind there. So do you see any risk at this time
Exactly.
that kind of the banking sector again would trigger it, kind of?
That's very good comparison, because it's exactly lack of understanding of risk and better modeling of this risk, bad capital coverage for this risk, which actually we are talking about in 2008, for example, correct? So it's completely similar situation here. So if you not very well understand how this particular company can be impacted by transitional risk or whole portfolio, whole industry, you can have quite big losses quite, in a quite rapid way. That's exactly a good comparison with 2008. So in this case, if you don't have enough capital, also you have also bad capital models, which is not covering that, you can have big problems. That's exactly the similar way. So that's good comparison, I would say.
But also that like in introduction of this on this new guidelines and rules would kind of would trigger this effect by itself. I mean, the company that maybe can get some liquidity, can get some credit at the moment today, and is functioning today, would not be functioning without that credit line any longer, and therefore kind of goes down.
Exactly. So it can be both trigger in industry, in banks, etc., in how it's called, not giving loans to these companies. So yeah, that's exactly like that. So it's kind of cascade effect will be. That's related to asset correlation I'm talking about. So there will be much more than in normal times asset correlation in such a situation.
That's kind of drastic outcome, I would say. Do you see any positive kind of outcomes as well, like better rates for more energy efficient companies or more sustainable companies?
Yeah, I will say that I cannot speak much about what is going on in the industry, and this stuff, but at least I will say that what we are doing, developing these models, which will in correct way show how much losses you will have, how much capital you need. That's a step in the right direction. If you will apply, you will see actually that before it happens. And based on that, of course, banks, can change their loan portfolio if they will see it is expected much loss here. It will be need much capital there. So you maybe will, as you mentioned, force these companies to kind of transition before we come into this point. That's why we need these models. We need good predictions.
Is there any way to kind of soften the impact that instead of sort of the regulators would take in some of the new methodologies, so to speak, and put the date that in a couple of years every bank needs to kind of implement that, and all the banks would account for the new parameters and suddenly realize that some sectors or some industries or some geographies are no longer feasible to provide credit for, or no longer, so to speak, that they are no longer profitable. What can how can the regulator or the industry kind of soften that impact?
Yeah, I would say exactly like capital models. Actually, they exactly serve for this purpose. So we even have these tools today in the Pillar 2 on assessment for capital requirements for all risk, including credit risk. So you can apply different models, even not best practice, etc. You need to just to defend them to regulators and to validation. So if they're quite robust, so you can apply it today. So and if they're working correctly, they will show you risk for huge unexpected losses for certain industry due to climate, for example, transition risk. So this, of course, will impact at the end of the day how much loans you want to have in this area. So from business perspective, you will see if you will see this and cost of capital, you will count that. At the end of the day, you will maybe diminish loans in this area, diminish this portfolio, and starting, to invest to somewhere else. So we have impact from that actually in good direction if we have correct models in this area, correct capital models in this particular case.
I see.
So I would say maybe even from that perspective, where we today, so maybe expected loss models of less importance because it's 1 year horizon and maybe not happened much in just coming 1 year. But unexpected loss models, they show a little bit another perspective, how huge losses can be with certain, probability to happen, which is predefined. So, and this, I cannot say it is horizon just 1 year here. It can, in this case, how it's called, reflect a little bit more what we have. And what can happen, for example, in 20 years' time.
I'm just thinking of those industries or regions, or like to put some specific sort of you mentioned, for instance, Holland, Netherlands. Maybe some farmers out there are at risk at the moment. Then and the banks decide that it is kind of a risky asset to have, and as you say, diminish their portfolios in that area. Where would those people and their businesses turn themselves to? Would that kind of kill the entire business?
It can be. Actually, I would say Holland is a very good example because as I see on presentations from different banks in Holland, they also quite on advanced level of developing these models. For example, in this particular case, loss given defaults. So loss given default, so how much losses we will have given default and if happens this stuff you are talking about. So of course, all of that, because I already take into account that quite much for expected losses. It's not like a long time horizon 20 years. It's just 1 year, I would say. And they already have this impact. So, of course, it's impacted portfolio strategy. So they diminish this portfolio, actually.
So this means that we will see some changes in those geographies. So maybe it would not be a farming estate anymore, but something else that can still have a kind of lower loss given default, for instance, if something would happen in that term. So that actually has the impact on what type of, because people would not kind of they would not disappear, but they would that modeling kind of forces them to start planning ahead and maybe do something else in order to protect themselves.
And for that purpose, Yeah, we need good models which reflect that. So if you don't have good models, it can be, 2008. Again, that's one of the reasons actually why it happens. So banks not estimating their risk properly, I would say. It's model risk.
Yeah, I'm just sort of trying to see some pros out of this entire exercise for those businesses, for those involved actually in doing the work. But of course, if their business really has a high risk, maybe it kind of forces them to think ahead. The bank would force them to think ahead about
Exactly.
how risky their real business is, and maybe that kind of would raise those questions about what they should do instead today, and not when the doomsday comes, so to speak.
That's exactly actually it's relevant to our first item in the research in Stockholm University to see if specific geographies and areas is already impacted by physical climate risk. So we have realization, we can see already clear realization in comparison with other areas not impacted of climate risk. So you can compare actually these two. And after that, we can compare other risk parameters like PD and LGD in this area, because we have this data also aggregated for all banks, actually reflecting that risk or not. So that will be a very interesting outcome as a first step in this research.
How far are you in that?
We are just in the very beginning. So I cannot comment any results. So that's just started. And I hope after 1 year, at least this item we can discuss in very much detail.
Okay, I'm sure. And when it comes to your recent paper about climate stress testing, yeah, it looks at translating environmental shocks into credit losses. What did you find most challenging about linking those physical things to default probabilities?
I would say that is most in relation to transitional risk, not physical risk. If you are talking about stress testing, the application of my paper from 2012. What I very much like in this approach, I like how nice and how very elegant mathematical language you can combine all this to impact in sound mathematical defendable approach, because sometimes you have problems with validation. For example, if you do some simple method which is maybe not justified by some methodologies or mathematics, so it's difficult to defend that because it's not statistical one. And here it is what I like mostly, that it's a very good combination of this of theory and practice in some way.
Wow. And you mentioned already that in some other regions like Netherlands, the banks are kind of very much on the forefront as well.
Yeah.
So
I would say in area of physical risk there, because they're impacted much by physical risk now, and in this area they're quite advanced, I would say. Yeah.
And how does that compare to other Nordic banks?
It's difficult to say because I don't know situations, in all Nordic banks. So, but we are all starting this work, as I understand. All starting. So I'm not sure how far, everyone in comparison with each other, but I never hear that someone not doing this at all. And we have kind of benchmarking through interbanking organization, and you see answers. So everyone started. The question is how advanced they are. That's difficult to say.
I see. I really see your point now that you are kind of, the point of your work is not necessarily just to deplete all those regions out of credit lines and sort of close the businesses, but rather to raise those questions before and kind of make those businesses to protect themselves and prepare themselves for these different scenarios to get ready, so to speak.
Yeah,
exactly. And the banks for that reason as well.
Exactly.
Right. Yeah. So if we're looking
No,
like
I
10
would
years
say I would say that we have generally in this how it's called modeling for credit risk approaches general situation quite similar to beginning of Basel regulation in the beginning of 2000. So when this framework was introduced. So the only difference now that we don't have any papers, this regulation can be based on. So in 2000 we have these papers actually, and Basel Committee takes them as an input, change it a little bit, and then now we have it worldwide regulation based on that. So it's completely similar case for climate risk. Now the only missing point is these papers, which our regulators can take as a guidance and starting to implement it.
Yeah, well, and hopefully we would not need to experience this kind of credit crisis again. And in terms of 2008 crisis, kind of pushed it even further, telling that the banks did not do sufficiently within the Basel regulation even back then, so that in 10 years from now, we don't experience the crisis that is saying that, well, the banks did not take this seriously enough. And so
maybe because after 2008, it was introduced term and, area, model risk management, model risk capital down, so I don't remember before anyone talking, before 2008 actually, talking about that. So now we have it everywhere for all type of models. So hopefully it will help, at least we will not have model risk realization.
Yeah. So if we look 10 years ahead, what does an ideal climate adjusted credit estimation, how would that look like?
So in my view, we will have kind of predefined approaches and formulas like for capital, like we have today for concentration risk, the similar we will have for concentration risk due to climate risk. Also, we will have capital requirements for climate risk in different scenarios. Also, it will be scenario dependent what actually way we are going to. So it will be adjusted RWA formula for that stuff. And for stress testing and IFRS 9, for example, it will be explicitly included actually in all simulations and calculations.
So it will essentially make it easier even for the smaller banks to
exactly
to implement without any questions.
Exactly. So they will take will be books also on that. So they will just buy it and use it. So nothing more. So only just parameterization will be specific for this particular bank.
Okay, I see. And finally, on a more maybe personal note, what motivates you to keep driving this research outside of your, main work within the commercial bank?
I very much like to work in research, actually. I was previously working in research. I have PhD in research. So, and here it is an area which will be used by banks. That's actually very much exciting. So you are developing by your hand something which will be used everywhere, as I mentioned, maybe in 10 years' time. So I'm very proud of that, actually. If I would, and it will be possible from my side to contribute to that, I think it's very good.
I see. Well, Alexander, that was a great summary of your engagement in this topic, and it actually explains a bit, at least, why you're so much involved in this outside of your working time. Anyway, as executive advisor, I'm sure that you have enough tasks on your plate anyway. So thank you very much for this insight into what we are to expect from the coming advancements and the regulations within the credit risk space. Och för alla som lyssnar, glöm inte att prenumerera på den här kanalen för att få en uppdatering nästa vecka och nya avsnitt som kommer ut då. Ha det gott!